Okay, we are going to move on. We're going to stay on the theme of heroes. We're celebrating our local and global heroes. And our next session is all about global heroes, tales of riding through mega rounds. Mega rounds, how cool does that sound? It sounds extra cool if you're an entrepreneur or a startup or a scale-up and you want a lot of funding. A mega round sounds like a very good idea. And we have two fantastic speakers here who are going to explore this hot topic in the world of startups and scale-ups. Okay, our moderator is a daily reporter for one of my favorite online publications. A big shout to my friend Mike Butcher if he's here. I'm, of course, talking about the mighty TechCrunch, and we are honored to have join us on stage our moderator. Please give it up for Anna Heim from TechCrunch. Thank you. Oh, there we are, back again. Okay, thank you. And we are now going to welcome to the stage her guest. He is the founder and CEO of Factorial, a great friend of 4 years from now, a brilliant speaker. Please give it up for Jordi Romero. Hi, Jordi.
So thanks, Jordi, for joining me on stage. I really like the title of this panel because it's calling you a hero, so I don't know how comfortable you are with that, but I think that's part of the story I want you to tell, because a lot of people admire you and probably dream of being like Factorial one day. But the question I have for you, and that we are going to develop in this discussion, is do they have to raise a mega round for that? And when does it make sense? And when doesn't it apply? So I think for starters, I'd love you to tell the story of how much you raised and what changed over time, because I'm sure the situation was completely different in 2021 compared to raising during COVID, compared to your first rounds.
Yeah, well, thank you, Anna. I'm happy to be here as a local. I don't know about hero, but definitely local.
Local, they put.
Local as well, yeah. So Factorial is a company based in Barcelona, but we sell globally. And it's true that it's a bit weird that there is this intense focus on fundraising and this like fascination about big round numbers, right? So like the whole unicorn thing. I mean, it helps us because a lot of people talk about us, but it doesn't really change the trajectory of the business. The fact that we're now valued at €1 billion. I think it's important for local, I would say in general, European startups, non-Silicon Valley startups, to believe that they can win big, that they can be #1 category leaders globally. I think it's important to have companies you look up to, companies that you want to follow, especially if they come from the same part of the world. So I'm actually proud that there are smaller startups coming out of Barcelona, coming out of Spain, or anywhere in Europe that say, look, you can actually build a leading or potentially leading unicorn SME SaaS company based in a place like Barcelona. It doesn't have to be San Francisco. It doesn't even have to be in the United States. It doesn't even have to be London or Berlin. It can be actually in Barcelona. So, I mean, there is some responsibility with that, but that's one that I take with pride. I look up to a lot of founders and entrepreneurs that are a couple of steps ahead of us, and I'm very happy to help entrepreneurs that are a couple of steps behind us.
Yeah, I was going to say you're also investing and advising a lot of companies, so you have that view that goes well beyond Factorial, and that's also why you know that what you did might not apply to everyone. But just catching up on what you said about also being local heroes, and one of the things that changed from between your rounds is having to travel to raise versus not having to travel. So maybe you can talk a bit about that.
Yeah, the fundraising environment changed drastically in the 14 years that I've been in this industry. It's been 6.5 years since we started Factorial. I spent a bunch of years in the past in another startup. And I remember when I first heard about VCs. VCs were these evil partners, money managers that would fund you and own you. And you would have to please them, and you would have to do whatever they want, and they would come with these very aggressive, mean contracts that you would not understand but would have to sign because that was the only way to get money. That's what I learned about VCs when I got into this industry. Over time, I learned, first of all, it wasn't that bad, but it was pretty bad. And then things changed. And then there was a power balance shift from only the money to only the founders, the talent, if you want, to the point of 2021, post-COVID, super fast rounds, couple of Zoom calls, literally 30-minute calls followed by a term sheet. before even discussing terms or sharing documents or stuff like that. So that was a little bit too crazy. To then like the big reset that we're suffering right now. When it comes to travel, it's true. In 2010, 11, we wanted to raise money for our previous company, and European VCs didn't really invest in software as a service. I would say they didn't understand or know software as a service businesses, so we were kind of forced to go to San Francisco and move there. So like pack our bags and rent a flat and do all the paperwork, relocate ourselves and the company and the capital and raise money from Silicon Valley investors. In 2020, when Factorial, we raised our Series A, we had to fly there, visit them in person, and we were able to raise money staying in Barcelona. So we took their dollars, brought them to Barcelona into euros, and we're still a Spanish company. 2021, post-COVID, couple of Zoom calls, crazy fast round, insane kind of VC peak moment. 2023, a little bit more deep conversations, a lot of due diligence, a lot of Excel spreadsheets, a lot of data room preparation and stuff like that, but still mostly virtual, right? So I think during the fundraise of our Series C, which was 120 million euro last year, there was no in-person meeting during the fundraise. We did meet in the previous months of the fundraise and right after closing, but the actual fundraise was completely online, which was unheard of just 2 years before.
Yeah, that's a big change for sure. And I think your round was actually one of, not the last mega rounds, but the number of mega rounds drastically fell in Q4. I was just looking up the numbers this morning, and it's probably not back to 2019 levels, but has nothing to do with what's happening a few months ago. And I think the reason for that is valuation, and I was wondering if you have some thoughts on how important it is to have a huge valuation as a founder versus other points.
Yeah, and you asked me about mega rounds at the beginning. I didn't want to dodge the question, but I'll take this now. So, I mean, mega round, I don't know what's technically a mega round, but I guess 120 million euro is a lot of money, and there is a lot you can do, and it usually comes with a large valuation for the company as well. I think this is a very powerful weapon, very powerful tool, is to capitalize the company aggressively, as we did. I think people shouldn't do mega rounds or big rounds or 10 plus, 100 plus million euro rounds just because it's cool or because it's in TechCrunch or because that makes you a unicorn. And unfortunately, I think there was a lot of that in the last few years. I think if you really, really, really kind of know your business and your metrics, and there is a bit like you're in the matrix when in B2B SaaS, in our business model, software as a service, you kind of understand what happens when you put a euro, you invest in go-to-market, then you recover it after number of months, then you start generating profit, you kind of understand these cash flows, then you say how much you invest in technology. There is a point where you just see this in your head, at least I do, all the time. And then it's like, well, I can make this huge if I have a lot of resources. And I can either wait until the cash flows to generate these resources, or I can just force this growth with a lot of capital. I think if you do that, it's fantastic to raise a lot of money because you know exactly what you're doing with this money. You allow for some mistake. When you grow very fast, not everything goes according to the plan. Things break, things take a little bit longer. A key hire doesn't happen or somebody in the team leaves, whatever, right? Pandemic happens. Like there are things that kind of you cannot control that change a little bit your plans. But you should definitely understand the economics of your business model and know very well that this euro that you're putting into the business is coming back, more or less in X number of months. Then I think mega rounds or venture capital in general is an extremely powerful tool. I also think that having the confidence of really dominating this business model, these numbers, these cash flow statements, a bit blurry but accurate in your mind, will also transmit a lot of trust in the investors because they will know or think that you're not just going to try to set the money on fire and hope for the best. They kind of see that you have a plan, and I guess that's what the investors want to see. So I think there is a space, but definitely I advise founders to not raise money unless they really, really, really know what they're going to do with that money, and they have high level of trust of what's probably going to happen. Because the last thing you want to do is to get diluted lose ownership on your company, kind of set some expectations that you cannot meet. Because then you lose the company.
Yeah.
And it takes a lot of sweat and blood and tears to build a company. And you don't just want to waste this and give it away because you set the wrong expectations. So I think raising money is fine, but you kind of need to be sure of what you're doing.
Yeah, but do you worry that companies that are maybe a bit less straightforward, like tackling important problem, but maybe less commercially understandable, they're struggling to raise right now? What would you tell them?
I think there are a lot of companies that are struggling to raise right now that should struggle to raise right now because they don't have a venture scale business. And the problem is we kind of read in the news for the last couple of years that everything was a venture scale business, right? And there are some big examples that we all saw Netflix documentaries about that, at scale, at the limit, don't really return the money. It's really difficult if you're doing a $40 billion valuation to return a 3x. That's a $100 billion, $120+ billion valuation. It's really difficult to do that unless you have a really scalable business model. Google has a really scalable business model. Okay, if you're building the next Google, then that's all good. You will raise money. It's going to be hard. It always is hard. You're going to raise money. But if you don't really have a business that has the trajectory of hyperscale, extremely good gross margins, scalable go-to-markets, not platform dependencies, not dependencies on paid go-to-marketing that will eventually tap out, and you will not be able to keep growing with more capital, which is what happens with most of the businesses that struggle to raise, then you should probably not raise money, and it's kind of like a good message by the market to say, look, you should figure out a way to grow your business with your own cash flows. And it's tough, but in most cases, that's actually the right answer. Mm-hmm. Now, there are some companies that I think have venture scale or the ability to be 100x, 1000x from whatever they're raising at, and they're going to struggle right now. It's going to be temporary. They should try to survive 6 more months, 12 more months, and they're going to be able to raise. The market, the investors are pretty smart people. They might be afraid in moments like this, but eventually they'll come to sense. They'll see the numbers, they'll see the metrics, and they say, this is actually a good business. I want to invest in this business, give them 2-3 years of runway, and see them grow and take some risk, but potentially return my capital.
Mm-hmm. Well, maybe I'm a bit less optimistic than you are, but again, that's why you're an entrepreneur, I'm not. But I was thinking of some of the threats that might impact Factorial, even if you're doing really well right now. And I was wondering if you think that having such amounts of cash acts as a buffer. For instance, if there are, I don't know, more competition in your space or less demand from SMBs for some reason that you don't control.
The market is a very interesting beast because you never know where it's going to come from. And we have been pretty, I don't want to say paranoid, but kind of observing the market for the last 10 months, since May last year, when we started seeing potential inflation, potential multiple compression in the public markets, which are indicators of recession, less venture capital, layoffs, which did happen. And our core market, which is, so Factorial helps, by the way, I didn't say that, SMEs, companies typically between 20 up to a couple thousand employees, automate all of their people management workflows, from hiring people to managing their compensation, running payroll, evaluating people's performance, even expense management, like very horizontal HR software solution for normal businesses. We don't sell to startups typically. We don't sell to big tech. We don't sell to large enterprises. We sell to like the normal real businesses around the world. And these people don't read TechCrunch. So they don't know that there is like a big crisis. They read about inflation and energy prices and stuff like that. But their core businesses aren't much affected by what's going on in the market. So our business isn't affected at all by what's going on in the market. We're seeing some impacts from other sides of the business, for example, talent. We used to have our engineers receive, I'm exaggerating maybe, but like a couple of offers from Facebook, Meta, Google, whatever, like these big tech companies by insane multiples of their current compensation, working remotely or barely working remotely from Barcelona. This doesn't happen anymore, so I guess they're less distracted by this like big tech noise. And we're seeing a lot of interesting M&A opportunities popping up. I guess there are, to your point before, great businesses out there, potential great businesses out there, that are not yet at the point where they have a clear path to profitability. I think you should always have a clear path to profitability. Ideally, you're profitable, right? But the second best is you have a clear path to profitability. We have a very clear path to profitability. As I said, these numbers in my mind, it's like investing and acquiring customers, investing in software, recovering this investment, and then good gross margins, profitability. At the early days of a company, usually pre-Series A or right up to Series A, you don't have this clear path to profitability. But maybe you have a good product, you have like good product feedback, usage, kind of growth, but you haven't figured out your customer acquisition channels and the economics, and maybe you just don't have the scale yet, so you can approve this path to profitability. Anyway, there are a few businesses at that stage that are struggling to raise money. Maybe they waited a little bit too long, they're running out of cash, and they need a home. VCs will not help them build a business on their own. Maybe we can. So that's actually something that we've seen drastically change in the last 3 months since we turned to 2023. We started receiving very high quality inbound of potential M&A targets, which is definitely impacted by the whole environment at the macro level.
Yeah, I think the parallel I'm seeing is also that used to be one of the reasons startups would, especially scale-ups, would go public because you would have the cash to do M&As, but in your case you raised enough that you're able to do that, especially with smaller targets that are not profitable, as you said, and don't have that path figured out for themselves.
I mean, I think some people claim that we might be geniuses because we nailed the timing and we had this, the reality is there's always a big luck factor. And we did see the environment, we saw the clouds in the sky, and we said, let's go try to raise the money fast back in May 2022. It wasn't fast because the clouds were already over us, but we did raise a good round, and then we actually raised the round in a little bit longer than we typically did because we got to like 70 million euro, and we said, you know what, it's annoying to be fundraising, it's exhausting, we're talking to a bunch of people, but let's work a little bit harder, raise a little bit more. So in hindsight, it looks like this genius strategy of raising more than we needed to now do M&A because we knew exactly what was going to happen. I mean, we had some ideas, but we're also lucky, and we did raise more than we needed, which now allows us to be in a really good position, not just to do M&A, but also for people to know that we might do M&A because people know that we raised more than we needed. So they come to us and they talk about their businesses. So yeah, I think the best thing that you have to do is to be alive. The second best thing is to just have a little bit more cash than you need, right? That's kind of like good life advice in general, running a business or not. Be alive and have more cash than you need, and then good things happen.
Yeah, talking about luck, I think one factor that completely disappeared from the market, especially at early stages, crossover funds. So I think you have Tiger on your cap table, yes. But now I would say it's impossible for an early stage startup to raise from Tiger and the likes.
Yeah, there was a lot of disruption across stages. I guess going back to the 2010s, when I learned about venture capital, things were pretty much well-defined. There were the friends and fools, there were the business angels, there were the Series A investors. And I love this concept of the kingmaker or the queenmaker, which is the Series A investor. Series A investor is where CRV, which was our Series A lead, the benchmarks, traditionally the Sequoias, like these classic Silicon Valley investors were pretty much only doing Series A's. And some of them only do Series A right now because it's a tipping point, right? Before that, it's not rational to invest. It's just like you really like this person and it's a small enough amount of capital that if you lose it, it's still worth it because you helped a good person try it. But the Series A is what makes a self-fulfilling prophecy. It's a good enough team with a good enough market and a good enough traction. By having this Series A and the Series A investor put a stamp on you becomes the reality that wasn't. And then there is the growth investors and the private equity and the public markets, right? So everybody had their own role and they were completely different fundraising processes from like, please, I beg you, I have nothing to show other than I'm not a scammer, give me money, I'll try hard. That's the pre-seed seed investor. Series A is like, we're going to win, there is the market, and then it's just numbers. Spreadsheets, an army of analysts and bankers, and kind of Like you don't even do anything as a founder, CEO. You just give them the spreadsheets and they decide if they want to invest and at what valuation. Now this is all super blurry because the crossover funds came from the public markets to pre-IPO because that's a nice 30 to 40% capital gain that you can get there with almost the same effort, so why not do that? And then it's super competitive, so the earlier you do, the easier to get into the stage, but they don't know how to analyze the companies at the earlier stage. But on the other hand, they're managing billions or tens of billions, so $5 million sounds like a rounding error, so they just spray a bunch of $5 million tickets, and this kind of like, completely disrupted the market. I think now they're pulling back, which is awkward, because like generations of founders talk to other founders saying you should do that, and that doesn't exist anymore, so there is a little bit of reset and unlearning that needs to happen. I think it makes sense that they are stage specialists and that founders know what they're selling. I mean, you're always selling your equity in your company, but you need to know if you're selling the team, if you're selling the market, if you're selling the numbers at each stage, and then evaluate the investors as such. We are very happy to have the investors we have. We have like Atomico, who led their Series C, and Atomico does a lot of A's and B's, but they did a C. One of the biggest rounds that they did was the Factorial round. On the other hand, we had Tiger, which is a huge crossover fund, did the B round. So it's like, probably the more natural path would have been Atomico do the B, Tiger do the C. It's fine, like we all get along, they're good people. We're all aligned because we all want the company to go forward, hit our objectives, and eventually return them a bunch of money on their investment, so.
I think one thing that's critical though is that sometimes VCs run out for their own reasons, and sometimes the market timing makes that difficult, so how do you deal with that as a founder?
I mean, one thing, look, I get this question a lot lately of like, how are you doing? You have Tiger on board, and they're changing the strategy because they read something on the news. And I'm like, dude, they're my partners. They want the best for Factorial. They're going to help as much as they can help us. I mean, mostly it's on us to actually return them money, but it doesn't affect us at all. The fact that they might have been more aggressive in the past and now they're doing fewer investments, it affects us zero. So they helped us a lot raise the Series B. Now they're on board the company. To your point, I think one thing that we as founders need to understand is their businesses very well. So going back to these evil investors with their aggressive terms from the 2010s, they're not bad people, they just have their own business to run, and they need to make sure that if they put money at risk, at least they can get their money back. They're going to try it, you can try to avoid that. So understanding their incentives, their timelines, their relationships with their LPs helps a lot. In our case, we have CRV, which is, I forgot how old, I think like a 50, 60-year-old fund. I don't know, like it's a classic Silicon Valley fund. They have 80 IPOs in their portfolio, 80, right? Like insane amount of IPOs. So their LPs will never say, hey CRV, give me my money back. Like you're gonna start showing returns, because they say, CRV, do what you do, you're very good at it. We'll just patiently wait and we'll take what you have for us. So it's really good to have these investors, they're super patient. On the other hand, we have some other investors which they're younger, and maybe they're on their first or second fund, and I know now that they have to show to their LPs some returns. So I know that they're going to be more in a hurry to start distributing money. That's fine, I will help them do that, right? So I will go to maybe one of our later stage investors and say, look, in this transaction, do you want to buy this other guy 1%? So they can start distributing money. It's all fine as you know it. The problem is, I think, when there is no transparency and the founder is ignorant of how the venture capital world works, and two, when the investor is not transparent. Because if the investor starts coming and say, hey Anna, I just found a buyer for my shares, and you're like, dude, no, I'm running the company, I will manage this. If they come and say, hey Anna, I would like to return some liquidities to my LPs. I can find investors, but if you want to be part of this conversation, super happy to do this together, which is literally what happened to me. So like, yeah, you just do this together and you help one of your early stage investors find liquidity, and you control your cap table, which you want to do as a founder, then it's all good.
Yeah, I think it's still great that you're sharing this, because lots of founders don't realize it's part of their job to manage that and manage VC expectations and so on. And another thing that founders maybe don't know a lot about, which was really common probably when you started 10, 15 years ago, was liquidation preferences, and now they are making a return. but probably not to the level that they were at a few years ago. Do you think it's a bad thing in itself, or do you think it's acceptable?
So liquidation preference is good when a company is valued on promise. So if I have a lot of money, I have 1 million euros, and I buy a factory that's worth 1 million euros. Inside the company is worth 1 million euros because it literally owns an asset that's worth 1 million euros. Now, if an investor comes, there is no liquidation preference because they're buying a chunk of something that's very clearly valued at that. That's not how startups work. A couple of young programmers with a good idea, a PowerPoint and an MVP, maybe a little bit of usage, will say, I have something worth 1 million euros. That's not worth 1 million euros by any kind of economic definition, but its potential it's worth 1 million euros. So a VC will come and say, here is 100K at 10% dilution, so 1 million euros. But the reality is there's no assets there. So the day after, the founders can say, haha, we're closing the company, we're taking 90% of your 100K, so 90K for free, they did nothing, you get 10K back. You just lost 90K, and you're like, I'm stupid, they scammed me. That's where liquidation preference comes in, is because there are no tangible assets that are worth the valuation of the company. So it's just a protection from bad founders or operators that might be wrongly incentivized to sell the company for nothing, just for the cash in the bank. Now, anything beyond 1x non-participating preference is evil, in my opinion. So that 1x means I put 100K in my example. Anything below 100K, I get 100K back. So it's a protection. I think that's fair. Now, people who say, no, I want you to guarantee that I'm going to make at least 10% IRR. No, that's not how it works. We need the equity. We're in this together. We're going to try to make it worth a lot more than 10% IRR, but I don't believe that makes sense. So I would advise founders to be very gracious with 1% non-participating preference equity. If you don't know what that means, you're screwed. You should Google it, you should learn. There are books about it. There's a book called Venture Deals. There's a bunch of books now about VC. Read a couple of books, watch podcasts, whatever. Learn about this because it's really important.
Yeah, it's so great that there are books for that. And just before we got on stage, we were talking about a recommendation that you have for Spanish founders to get a bit more leverage on terms, and I think it was going international. You want to share that?
Yes, that was backstage. But yeah, the reality is there are microcosmoses. So if we're having a conversation with Spanish investors, a Spanish company has a conversation with a Spanish investor, in the context of this is a Spanish fundraising, the reality is you'll get one type of term sheet, one type of negotiation and terms. If you're a Spanish founder talking to a Spanish investor in the context of a European fundraise, and somehow the investor knows that there are other non-Spanish investors in the conversation, they'll pull up another term sheet, which is completely different. And there's two reasons for that. One is they know they have to compete with a lot more advanced, sophisticated investors, and they also don't want to look evil to the European investors because otherwise they're not going to get deal flow by them. So I always advise founders, there's nothing wrong with Spanish investor. I'm an investor, I'm based in Spain, so nothing wrong with Spanish investors, but I think you should raise the playing field to at least European, ideally global. So get on a flight, get on a Zoom call with Silicon Valley investors, London-based investors, Berlin-based investors, Barcelona-based investors. We're all potentially nice people, good investors, but don't limit yourself to a closed ecosystem because that narrows down the possibilities and it brings you back at least a decade, maybe two, in terms of the quality of the terms that you might get.
Yeah, I think that's a great piece of advice, and I think people are looking for recommendations, so I want to open the floor for questions. If anyone has questions. Can you see? Anyone? Come on, you're here because you want some advice for him, so. No. Can you see? Here.
Hello.
Hello.
Sorry about that. So just a quick question. You mentioned before, by the way, very, very insightful conversation. You mentioned before something about this, it might not be the good time for raising money, and the best thing you can do is stay alive. Related to this, you also mentioned that there's a lot of companies that are not targeted or appropriate for raising money, or it's not even a good idea in many cases. So what would be your advice or ideas about bootstrapped companies?
I mean, good luck. It's the only advice I can give. Obviously, the best company is the one that's alive. And the best way to be alive is to generate cash flows instead of consume cash flows. So, I mean, I'm saying very stupid things, but it's really like the basics of this. A big part of our job as founders, CEOs, is to take risks, or to place bets, or to make investments, which is literally the same thing with the 3 different names. So calculate the risk that you want to take, right? Build up kind of like a confidence, a network, warm up the room or the pipeline for the fundraise before you start growing the burn rate, for example, because you might see that you cannot close or the valuation you're getting is not one that you like, and then you need to pull back. And best if you don't have to lay off half of the company for many obvious reasons. So, like, I would really adjust the risk that you take. The only challenge there is time goes against this risk adjustment. Let me explain that. The best way to get a good valuation is to be growing very fast. Growth is the only thing that matters, the number one thing by far. Now profitability and efficiency also matters, but growth is still number one. The best way to grow is to spend money. Now, if you spend money, you are closer to dying if you're not profitable. So the more money you spend, the more you grow, the more valuation, best investor you will be able to find, but the shorter time you have. So really, really, really accelerate. So the only actionable advice I can give you is like move crazy fast. Even today, you can move fast. Like do things in days, not weeks. Set a clear expectation of like, I'm fundraising, what is today, 1st of March? I'm fundraising between now and the 13th of March. And that day I will choose a term sheet and then I will close before the 30th of March. Now you might not be able to hit those deadlines, but if you try, then you're going to be closing in the 20th of April, which is still pretty good. Most people that start fundraising now will close in July. So if you set crazy aggressive deadlines, you will be much faster than the rest, which allows you to be more aggressive with the burn, with the spending, with the growth, which will give you a better valuation or a best shot at closing the round in moments like now. So I don't know. Hopefully that helps.
I think that was great advice. And I just wanted to thank you for everything you shared, because I think even if each company is unique, I think it's important for people to understand that the part to retain about what you did is not necessarily being a unicorn, it's not necessarily raising a mega round, it's just having the cash to be profitable and build a sustainable company that's going to return VCs their investment. So thank you very much.
Thank you, Anna.